The global sales momentum for electric vehicles is slowing down, while hybrids and plug-in hybrids (PHEVs) are proving to be more competitive than was once believed. Kota Yuzawet, an analyst at Goldman Sachs Research, has stated that the team's bear case for electric vehicle sales is becoming more realistic as sales continue to decline. At the same time, he believes that there are chances for investment in automobile manufacturers that have robust financial sheets and lineups that include a variety of powertrains. In addition, the group anticipates that the demand for electric vehicles will steadily increase in tandem with the quest of carbon neutrality. We asked Kota for his opinions on the future of the electric vehicle sector around the world. On the electric vehicle market, what are the headwinds? We are of the opinion that there are three primary factors that suppress EV uptake. To begin, there is a growing concern regarding the capital costs of electric vehicles as a result of the realization of reduced pricing for used EVs. Used electric vehicles have seen a significant drop in price in the United Kingdom over the past few months. 2. The lack of clarity surrounding a number of elections that took place this year has made it more difficult to see prospective shifts in government policy that could have an impact on the electric vehicle market. An inadequate number of rapid charging stations is the third and last issue that needs to be addressed. Rapid charging station infrastructure difficulties have surfaced as a practical challenge as the penetration of electric vehicles continues to grow. Several automobile manufacturers have expressed their growing concerns regarding the driving range and charging infrastructure of their vehicles. Customers might have second thoughts about purchasing an electric vehicle as a result of these concerns. What kind of effects has the slowdown in electric vehicles had on your projections? In light of the three unfavorable variables that were discussed earlier, we believe that our bear scenario, which predicted a year-over-year decrease in the amount of electric vehicle sales in 2024, has become more plausible. In a previous post, we proposed that the penetration of electric vehicles could be somewhat variable depending on the circumstances. While electric vehicles are experiencing a pause at the moment, our base case scenario still forecasts that the volume of EV sales will increase by 21% year-over-year in 2024. On the other hand, according to our worst-case scenario, the volume of electric vehicle sales would decrease by 2% year-over-year. Negative growth is expected to result in an oversupply throughout the electric vehicle supply chain. What is the current situation with hybrid sales? In spite of the slowdown in sales of electric vehicles, sales of hybrid electric vehicles and plug-in hybrid electric vehicles have been increasing. Over the course of the last few months, growth in the United States has exceeded that of electric vehicles. This leads us to predict that global sales of hybrid electric vehicles could surpass the forecast by 1 to 2 million units. Although hybrid electric vehicles are considered to be a transitional technology, we anticipate that there will be a greater emphasis placed on them in order to assist in the reduction of carbon dioxide emissions while simultaneously maximizing earnings and encouraging investment in electric vehicles for automobile manufacturers. When it comes to payback period, hybrid electric vehicles have a major advantage over electric vehicles. Taking into account the annual savings on fuel, we predict that the payback period for hybrid electric vehicles will be somewhat more than 3 years. In addition, considering that the first hybrid electric vehicles were available for purchase in 1997, we believe that there is a high level of confidence in the prices of used HEVs. But we also argue that the economic rationality of HEVs is not the only factor that should be considered when selecting them. As a matter of fact, hybrids have demonstrated higher horsepower performance than automobiles powered by gasoline engines. When drivers are faced with situations that need them to merge into fast-moving traffic on highways, for instance, motor assistance when accelerating is likely to offer them with much-needed reassurance. In the midst of the reduction in the size of gasoline engines, we believe that the performance of HEVs could draw more attention. However, we anticipate that the benefits of electric vehicles will once again be brought to the forefront if the costs of EVs are reduced by the year 2030. In what ways is China influencing the electric vehicle sector around the world? China has an excess production capacity of more than 5 million automobiles, and the country's goal is to increase the number of electric vehicles utilized within the country as well as sell them to markets outside of China. Given that China has a concentrated electric vehicle supply chain, including for batteries, the country enjoys cost benefits. Furthermore, we believe that China is the most competitive in the lithium iron phosphate battery market. In the United States of America, Europe, and India, there are numerous government laws that aim to prevent electric vehicles from China and other foreign countries from obtaining a foothold in their respective EV supply chains. Given that the demand for electric vehicles outside of China is not particularly high, with the exception of these 3 regions, we believe that it is highly improbable that China's supply surplus will be readily erased. In light of the fact that Chinese electric vehicle manufacturers are confronted with a challenging overall landscape in terms of exports, it is becoming increasingly vital to keep a closer check on winners and losers among them. Japanese brands have been able to maintain a high market share in Southeast Asia for a number of years, but Chinese electric vehicle manufacturers do offer a significant threat to these brands. Since 2023, the market in Southeast Asia has been a significant destination for the export of electric vehicles from China. In light of all this, what does it mean for investors? In what kinds of businesses should they begin their search? It is time to make an initial investment in vertical integration at this point in time. We believe that it will be essential for automobile manufacturers to take strong action over the next several years in order to amass essential electric vehicle technologies, batteries, power semiconductors, motors, and so on. This is because we anticipate that demand will eventually evolve toward electric vehicles in an effort to achieve carbon neutrality. In addition, we believe that the strength of the balance sheet and the capacity to produce free cash flow from current operations will be critically important in order to sustain this ongoing investment endeavor. We have a bullish outlook on automobile manufacturers which have robust balance sheets and lineups that include different powertrains, such as hybrid electric vehicles. As a result of the industry's continued calls for the government to provide incentives for private customers, sales of electric cars are not keeping pace with the overall market, according to the numbers. As of March, the Society of Motor Manufacturers and Traders reported that approximately 15.2% of newly registered automobiles were battery electric vehicles. Some graphs represents a decrease from 16.2% in March of the previous year. However, sales to people decreased despite the fact that the number of electric cars registered to enterprise fleet customers grew. The month of March, which is normally the busiest month of the year due to the introduction of new number plates, saw an increase in sales of all sorts of automobiles, including hybrids, diesel vehicles, and gasoline-powered vehicles. According to the SMMT, the number of units sold climbed by 10.4%, reaching 317,786. Despite the fact that sales are still significantly lower than they were before the pandemic, this was the best performance for the month of March in the past 5 years. Sales to fleet purchasers, which include firms like taxi and car rental agencies, increased by 29.6%. Fleet buyers include enterprises like these. On the other hand, sales to private buyers dropped by 7.7%, which the SMMT attributed to a challenging economic environment that included low growth, weak consumer confidence, and high interest rates. In addition, the trade association stated that the decrease in market share for electric vehicles underscores the need for government to support consumers. A sluggish private market and shrinking EV market share show the challenge that lies ahead, said Mike Hawes, the chief executive officer of the SMMT. Manufacturers are providing compelling offers, but they can't single-handedly fund the transition indefinitely. In the years to come, automobile manufacturers may be subject to financial penalties if they are unable to improve the percentage of zero-emission vehicles that they sell. Subscribe to our channel now to watch more videos like this. Thanks for watching.